The war trade is dead. Seriously, it's over. As the Strait of Hormuz finally reopens, we're looking at a staggering $353 trillion in global debt that is frantically looking for a new home. And let me tell you, it is violently exiting the safety of oil. For months, the smartest guys in the room were hiding behind one dominant strategy. Go long on gold, go long on oil, and just brace for the absolute worst in the Middle East. Well, that consensus, it's definitively dead. Welcome to today's Explainer. We're diving straight into the Hormuz peace dividend and the massive short volatility play that's literally rewriting the global financial architecture right now in May 2026.
The sheer scale of this macroeconomic pivot is just staggering. $353 trillion. That's not a typo. According to the Institute of International Finance, that's the record high of global debt we hit in the first quarter of 2026. During the crisis, a massive chunk of this capital just parked itself in safety assets, right? So the splash of cold water for the market today is this. Where exactly does this massive wall of capital go now that the war is ending and it desperately needs a more productive home?
So here's our roadmap for this explainer. First, why the word trade is dead. Second, the 2026 crisis and de-escalation. Third, the massive liquidity flush. Fourth, the discretionary stocks recovery setup. Fifth, the retail K-shaped trap. And finally, navigating the peace cycle.
Section 1. The war trade is dead, from fragmentation to the peace dividend.
We're witnessing a tectonic pivot away from that whole oil scarcity panic that dominated the past decade. For the longest time, the market was entirely predicated on a permanent state of risk. But oil is dropping rapidly as Iran talks progress, and this is the peace dividend dynamic you really need to understand. Following the initial U.S.-Iran resolution on May 6th, Brent crude futures plunged nearly 8% in a single day, even briefly dipping below that huge psychological barrier of $100 a barrel. Literally overnight, the long oil trade went from being a tactical necessity to a massive structural liability. The fear is just draining out of the market.
Section 2. 2026 Crisis and De-escalation. Mapping the Hormuz conflict.
Now, to really grasp the magnitude of this liquidity shift, we have to remember just how severe this crisis was and how insanely fast it escalated. Back in February 2026, the Strait of Hormuz closed, and Brent crude spiked from $61 to $115 in just 24 hours. By March, amidst a relentless aerial campaign, oil hit a peak of $126 a barrel, and gold surged to an unbelievable $5,600 an ounce. We were staring down the barrel of a devastating global recession. April brought a failed ceasefire and a formal U.S. naval blockade, choking off those vital supply lines. But then, a total whiplash pivot in early May. Operation Project Freedom is suddenly paused, great progress is cited for a peace deal, and just like that, months of intense, suffocating geopolitical chaos dissolved into a massive de-escalation narrative.
Section 3. The massive liquidity flush. Releasing trapped capital.
So, the story is no longer about the geopolitical catalyst in the Persian Gulf. It's about capital violently flowing out of defensive postures. We're looking at a complete 180-degree pivot here. Under the old regime of oil scarcity, we were dealing with trapped petroleum, soaring stagflation risks totally haunting the S&P 500, and everyone piling into war hedges. But the new regime? It's all about this massive liquidity flush. The Strait of Hormuz reopening means global stocks are normalizing. U.S. authorizations are actually allowing up to 440 million barrels of Iranian supply to hit the global market. We're literally trading a fear-based scarcity model for a massive deflationary abundance of liquidity.
To really put this into perspective, consider this staggering figure. $1 trillion. That was the estimated aggregate global cost impact of the 10 million barrels per day that were physically removed from the market during the height of the blockade. Think about the sheer friction that put on global commerce. It was like driving with the emergency brake pulled all the way up. With traffic resuming and those barrels flowing again, that immense cost burden is lifting off the global economy. It's acting as a massive stimulant for growth.
So what does this tangible peace dividend actually look like? Well, it's a massive influx of capital. We're looking at $300 billion unlocked in energy services for drilling and refining, $100 billion in IT and AI network infrastructure, $150 billion in consumer goods, and another $100 billion in tourism and aviation, all as the Iranian economy reintegrates into the global system over the next decade. Analysts aren't just calling this a recovery, by the way. They're comparing this economic unlock to the fall of the Soviet Union in terms of sudden global market expansion. For investors, this is the ultimate long volatility play. You're betting on explosive economic growth rather than geopolitical chaos.
Section 4. Discretionary Stocks Recovery Setup. The Micro Correlations.
Okay, so we've looked at the macro liquidity flush, but under the surface, there's a fascinating micro-correlation happening. There's a direct, inverse relationship between collapsing Brent crude prices and the recovery of consumer discretionary stocks. Put simply, retreating energy costs act as a massive, immediate tax cut for the everyday consumer, and all that extra cash in their pockets, it directly fuels consumer-focused market recoveries.
You can actually track exactly where the smart money is going. We're seeing a massive capital rotation out of oil hedges, out of gold, and directly into consumer discretionary, names like McDonald's, and travel like Expedia. These specific stocks are acting as giant liquidity sponges. They're soaking up the wealth that's rapidly exiting the dead war trade, precisely because they are the immediate beneficiaries of consumers having cheaper gas and way more disposable income.
Let's get specific with these micro-examples, both of which are highly relevant because, hey, they're actually reporting earnings today. McDonald's is capturing major market share in this post-inflationary world with strategic catalysts like their new Big Arch Burger. It's driving serious foot traffic back to their stores. Meanwhile, Expedia is heavily leveraging the travel recovery with structural moves like their Uber-Expedia partnership, which creates this incredibly seamless ecosystem for tourists. Both of these companies were heavily squeezed by cautious consumer behavior during the blockade. Now, they're perfectly positioned to capitalize on the peace dividend as consumers confidently start spending again.
Section 5. The Retail K-Shaped Trap. The Psychology of the Bag Holder.
Now here's the brutal truth. While institutional smart money is riding this consumer recovery, there's a brutal psychological trap currently devastating retail investors. The retail K-shaped trap is a pitfall where everyday investors hold war hedge assets like oil and gold way too long into a peace cycle. They anchor their portfolios to the recency bias of those massive May oil spikes, and as a result, they face severe wealth destruction. They're getting crushed at the pump and in their portfolios while institutional capital seamlessly pivots to the growth side of the equation.
As our sources explicitly highlight, retail sentiment, often fueled by fear, leads many to hold oil and gold too long, missing the inflection point where those assets become toxic. It's a tough pill to swallow, but if you're a retail investor stubbornly waiting for oil to go back to $126, you're going to get left behind. The true alpha here is positioning yourself above the uninformed retail crowd that gets trapped holding the bag.
Section 6. Navigating the peace cycle, the tactical playbook.
All right, let's get into the exact step-by-step tactical playbook professional market participants are using to aggressively capture this consumer recovery. Step 1. Short volatility. You need to capitalize on the compression of the terror premium in oil futures. Step 2. Long consumer discretionary. Re-rate those liquidity sponges we talked about, like McDonald's and Expedia, who are taking full advantage of this consumer tax cut. Step 3. Hedge against retail sentiment. Get out of those toxic gold and oil safety positions as institutional money flows into Japanese bonds and AI-led equities. And step 4, monitor the $353 trillion flush. With the global debt dam breaking, you want to heavily favor growth assets and sectors with high capital intensity.
Let's look a bit closer at the mechanics of Step 1. Brent crude is locked in a headline-driven range right now, but it faces severe structural downward pressure towards $60 a barrel as physical traffic through the Strait of Hormuz finally normalizes. The long oil trade is no longer an opportunity. It is a straight-up liability. That short volatility play is the definitive trade of the decade as this critical geopolitical choke point officially opens back up to global commerce.
Which brings us to our final takeaway. As that $353 trillion dam of global debt breaks, the question for investors is no longer where do we hide, but how fast can we grow? The peace dividend of May 2026 isn't just a neat chart pattern. It's a complete re-rating of the global economy after a highly dangerous brush with energy-driven stagflation. The war trade is dead, the capital is moving, and the liquidity flush is here. So the only question left is, are you positioned to capture it?